AST SpaceMobile is disrupting a $1.1 trillion market by being the first and only global network in space that connects directly to an unmodified 4G or 5G mobile phone. The differentiator they will offer is 100% coverage anywhere around the world. AST will be able to grow their revenue quickly, as rather than try and sell direct to customers, they have formed partnerships with the world's leading cellular networks that will give them access to 3 billion subscribers globally. By partnering with carriers, AST SpaceMobile isn't just targeting the billions of people without service, but rather they are incentivizing these carriers to offer the service to their own customers as a premium feature. A 100% coverage with zero modifications to one's phone seems like a fantasy, but since 2023, they have proven 4G, 5G voice calls on Vodafone and AT&T. Most recently, they even demonstrated success with video calls on the AT&T, Verizon, Vodafone, and Rakuten networks. Based on this, AST SpaceMobile is now committed to recognize revenue of $50 to $75 million in this back half of 2025 as they start turning the page and turning their capabilities using low bandwidth wireless spectrum. You may have noticed that there is one major carrier missing from AST's partners, and that is T-Mobile. T-Mobile decided to partner with Elon Musk's Starlink service. Usually, I would be concerned about competing with an Elon Musk company on the premise of innovation, but in this case, AST SpaceMobile has the edge. AST designs and manufactures these large satellites called Bluebirds that are capable of 10,000 megahertz of processing bandwidth per satellite. These higher bandwidths are what enable 5G video calls. Starlink, on the other hand, deploys much smaller satellites that support much lower bandwidths and broadbands with their smaller antennas, so are much more limited to low data rate services like text messages. Starlink can eventually enable AST's broadband capabilities, but would need to have 100 times the amount of satellites that AST deploys to enable this, which is just a cost burden. With AST now being able to start recognizing revenue, this is an exciting time to start investing in AST. The question for me, though, is after their insane stock surge as their 2021 IPO, is their valuation fair enough now to have enough upside for a long-term investor like myself? Before we look at a 2030 fair valuation for this stock, please read the disclaimer in the notes below. We are not financial advisors, nor anything we say should be taken as financial advice. Also, if you like videos like this, please help us out and click like and subscribe as we aim to analyze the world's most innovative companies twice per week. Now let's look at my 2030 valuation scenario for AST SpaceMobile. From a business lifecycle perspective, AST SpaceMobile is here, transitioning from the startup phase to early growth phase. When at this point, the key aspect that matters is revenue growth, especially exponential revenue growth, even in the triple digits. So to evaluate AST, I need to quantify its 2030 revenue outlook and apply a feasible price-to-sales ratio for them. To understand revenue outlook, let's look at T-Mobile's recent beta test in rolling out Starlink as a premium add-on. During this trial, they were able to convert 1.8 million of their 134 million customers to utilize, roughly 1.5%. I do believe that AST SpaceMobile can meet this as they are starting rollouts now, so in 2030 will be 5 years post-commercialization. T-Mobile's pilot also allowed just simple text messages for $10 per month. AST will enable 5G broadband, so video calls will be possible. Thus, I believe AST could capture 2%, at least, of their provider subscribers, which with 3 billion subscribers amongst their partners would give them 60 million subscribers. If T-Mobile was charging $10 for basic text per month, I believe that AST can charge $20 per month for their superior service. They will split the revenue 50-50 with the mobile network operators, so it would capture $10 per month from this price point in revenue. There is value for consumers to have this service be a permanent add-on to avoid having to deal with the hassle of just activating day passes when moving in and out of coverage zones. In total, just 2% conversion gives AST $6 billion in recurring revenue. Important to note that in this assumption, it does not factor in any federal government or defense contracts for service, nor any day pass user add-ons who will pay if they go for a day hike, or it will not be counting any customers that they're able to attract who currently have no cell service today. Overall, though, let's use a $6 billion revenue run rate. For a price-to-sales ratio, I do think that AST's revenue will be reoccurring, so should be valued similar to lead-in software-as-a-service companies in a high-growth industry. For data analytics, Snowflake, when it IPO, was a high-growth stock, and today it still trades at 20 price-to-sales. CrowdStrike is currently even trading higher with a 30 price-to-sales. Both these companies trade in a high-growth, trillion-dollar segment, so it's similar to AST in that regard, so I do think that for a comparable, it is a fair comparison. To give AST a bit of a margin of safety, let's use a 15 price-to-sales multiple. Pulling all this together, it gives AST an $80 billion market cap possible for 2030 for a base case. Pretty solid upside still, even after the stock has run up. Now, a big assumption for this thesis is that AST needs to be able to service the 3 billion individuals from around the world with service. To do this, AST needs to continue to launch their satellites, in which today they have 5 Bluebird satellites. However, to get this coverage, they need to launch up to 110 satellites into orbit. Cash-wise, I do not think this is a problem, as cost estimates are about $2.4 billion to launch all 110 satellites, whereas our cash position today is $0.9 billion. To raise the couple billion in cash that they need shouldn't be a problem because it's minimal share dilution from today's valuation, so cash really isn't the problem. More so, it will be, can they execute and launch 20 times the number of satellites they have today by 2029, which is their target. Nevertheless, this company has a very solid risk-reward upside scenario. Now let's run AST SpaceMobile through my framework. From a leadership perspective, I give them a very strong. They are founder-led, and their founder is widely regarded as a visionary in the satellite communications industry. Before founding AST, he successfully founded and sold another satellite space communications company. Probably the best possible CEO for this company. For valuation, since it has roughly 3x potential, I give this a strong. Only reason it isn't higher is the stock has about 4x'd its price since the beginning of this year, so I do wish I discovered it sooner. For revenue and profit growth, I give it a neutral. It is rated so lowly though because they hardly have any revenue this year, without a chance for profits until the 2030 date. However, the partnerships with leading mobile companies gives them access to 3 billion potential subscribers instantly, as soon as they are able to activate their satellites. For total addressable market, I give this a very strong. Everyone in the world can now have internet to mobile coverage, which is a $1 trillion market. Lastly, for secular tailwinds, I give this a strong. Besides this truly being a game-changing innovation, this will allow the Internet of Things industry to really begin to expand its capabilities. In addition to solving a real problem for billions of people in the world that currently lack reliable cellular coverage. Overall, I'm a yes to add AST SpaceMobile. I surprise myself here, as usually I don't like to invest in pre-revenue companies, especially when they run up so much. But they are so close to commercialization, and they solve a really large problem. The stake I'd want to add, though, would be really small, around sub 1%. And I'll be looking to add in the next few weeks, once the technicals look better. What do you think, Dad, as you take a look at AST SpaceMobile? And do you agree that we can add?
Thank you, Scott, for that excellent presentation, graphics, and analysis. Okay, I like to do my technicals for ASTS, symbol ASTS. Okay, the dividend is 0%. The beta is 2.41, which means it's 141% more volatile than the S&P 500. The market cap is 26 billion and earnings comes out around November 13th. So for that, it's a neutral. For the earnings history, it's pre-revenue, so I don't think we're going to see any consistent earnings for till 2030. So anyway, it's missed all 4 quarters, the last 4 quarters. So that's a negative. Profit margin 0. Debt to equity is around 30%, and it has no PEG ratio because it has no earnings. And as I said, it should get earnings and revenue in around 2030 after they launch all the satellites that they need. So for that, I'm a neutral to negative. For stock technicals, for the moving average, the price is above the 50-day, and 50 days above the 200, and the 200-day moving average is positive slope. But the thing is that the price is 100% above the 200-day moving average, which is very high. Bollinger Band, as you can see, it's right at the mid band. It's hugging the mid band, which is the 20-day moving average. Slow stochastic oscillator is 35, so that's neutral. MACD is negative, and unbalanced volume is neutral. So for that, I'm a neutral to positive, only because the moving average is doing so well. So, and that's being a little generous. Okay, and then for analyst coverage, there is 2 strong sells, 3 holds, and 3 strong buys. And the analysts are saying it's going to be like 49 to 58. So right now it's at around 80. So that's a big haircut it could get from 80 to 60 is what the analysts are thinking. But as I said before, the analysts don't know any more than us. And then the institutional coverage, only 35% of institutions hold shares. So in other words, of all the shares, 35% are held by institutions. So anyway, I'm a no, Scott. It's re-revenue, and I'm a no. I wouldn't even think about touching it until it gets to maybe in the high 50s. Yeah, because of what the analyst said, and because, as I said, the price is 100% above the 200-day moving average. So I'm a no, and if people want, they can keep an eye on it, but I wouldn't even consider it until it gets maybe in the 50s. So back to you, Scott.
Overall, we both believe the innovation they'll provide is major, and it should be an accelerant for the Internet of Things industry to finally take off. But for us to add to our community portfolio, we both need to say yes. Right now, John is not happy with the stock price being 100% over the 200-day moving average. With that said, thank you for watching. Please click a like and subscribe as we aim to cover the most innovative companies twice per week. Until next time, happy investing.